5 Melbourne suburbs, all middle ring, all under $900,000. All with vacancy rates below 2% and fewer than 1% of stock being added per year in supply. This is the structural combination that creates capital growth. Not headline one-year price moves, not growth corridor marketing, a constrained supply base meeting consistent rental demand, compounding over 5 to 10-year cycles. In the next 13 minutes, I'll walk you through all 5. The vacancy trends, the building approval ratios, the hold periods, and the growth profiles. This is the PropSpotter filter applied to middle ring Melbourne, and here's what survives. Before we dive in, if you're new to the channel, I'm Sean and I run PropSpotter. We're a property investment framework built on 3 pillars: research, source, and coach. What that means in practice is this: we use over 30 institutional grade data sources to identify the right suburbs for your strategy. Then, our proprietary listing system monitors those suburbs 24/7 and alerts you the moment a new property goes live, before most investors have even opened real estate that morning. And then we coach you through every step, from evaluation of the property through to settlement via a dedicated WhatsApp group. It's everything a buyer's agent provides: the research, the sourcing, the guidance, except you keep the skills, you stay in control of every decision, and it costs a fraction of the price. We've coached over 100 investors across Australia with a perfect 5-star rating on Google. If you want to learn more, the link to book a free strategy call is in the description. Now, let's get into the data. Let me frame why this list is specifically middle ring Melbourne, not inner ring, not outer, not regional. Because the choice is deliberate and it's driven by the underlying data. Capital growth in Australian property is fundamentally a function of demand exceeding supply over long periods. Not of recent price moves, not of growth corridor marketing. Structural supply-demand imbalance compounding. Inner ring Melbourne, Fitzroy, Carlton, South Yarra, Prahran has been compounding for decades because it's been structurally supply constrained the whole time. Heritage overlays and zoning prevent meaningful new supply, but entry prices are well above any working investor's budget ceiling. Outer Greenfield Melbourne, the growth corridors where land is still being released, looks cheap but behaves differently. New estates keep releasing stock. Each new estate is comparable to the last one. Supply elasticity is high. Price growth gets capped as developers keep adding inventory. Middle ring Melbourne, the band roughly 10 to 20 Ks from the CBD, sits in the sweet spot. Entry points in the $700,000 to $900,000 range are most attainable for investors. Zoning is settled, council approvals for new subdivisions are rare, and the suburbs are structurally built out. Existing housing stock is fixed. Population keeps growing. Demand meets constrained supply. Filtered for vacancy under 1.5% and building approvals ratio under 1%, here are 5 middle ring Melbourne suburbs where the setup is the loudest right now. West Footscray, postcode 3012, Maribyrnong, LGA. Number 5 on the list and the suburb with the cleanest supply pipeline of any I looked at. All bedroom, typical house price, 1.05 mil. Above the filter's $900,000 headline ceiling, but the 2-bedroom median sits at $744, which means for townhouses, villas, and smaller dwelling investment stock, West Footscray is directly accessible. The supply numbers are elite. Building approval ratio 0.33%. That's 9 approvals across 6,300 dwellings. Hold period 11.3 years. Vacancy 1.89. 10-year rent growth has compounded at 4.9% per year. That's above Melbourne metro average and tells you the demand side of the rental market has been consistently growing faster than supply, a leading indicator for eventual price catch-up. Why it sits where it does. West Footscray is the quiet residential pocket northwest of Footscray proper. Less restaurant scene, less bar density, fewer Instagram tags. Same underlying supply dynamics, same proximity to the CBD and the employment corridors of Werribee, Port Melbourne, and Parkville. This suburb works best as a townhouse, villa, or smaller dwelling investment play. If your strategy requires standalone houses, the $1.05 million typical puts it above budget. If 2-bed or attached stock is part of your approach, the supply dynamics are the best on this list. Thomastown, postcode 3074, Whittlesea, LGA, number 4 and the suburb with the strongest recent cycle acceleration on this list. Typical house price $870,000, rent $500 a week, yield 2.97%. The headline here is the 1-year price growth, 11.7%. And it's happening against a structurally supply-constrained backdrop. Building approval ratio 0.47%. Hold period 12.8 years. Residents simply don't leave. Vacancy 1.5% and trending down from 2% 6 months ago. Why does it sit where it does in the market? Thomastown has historically carried a mid-range socioeconomic or disadvantage index, with some concentrated industrial zoning on its western edge. Investor attention has tended to cluster in Bundoora, Reservoir, or Preston further south. That's kept Thomastown's entry point lower than those neighbouring suburbs. Meanwhile, Thomastown sits 15 kilometres from the CBD, serviced by the Mernda train line and structurally built out with zero remaining greenfield within the suburb boundary. That combination, low entry, tight supply, rising demand, is what's producing the 11.67% annual move. Strategic fit, this is a capital growth first play. The yield at 2.9% is the lowest on the list, which means cash flow burn is the highest. It requires a good serviceability headroom and works best for investors who can accept 2 to 3 years of higher after-tax outgoings in exchange for expected capital appreciation. Sunshine North, postcode 3020, Brimbank LGA, the Western Corridor middle ring pick. Typical price, $875,000, vacancy 1.29%, building approval ratio 0.59%, 1-year growth 9.46%. Sunshine North sits in the inner Western Corridor about 12 k's from the CBD. Brimbank LGA is undergoing long-term demographic transition. The Sunshine Hospital precinct is being expanded. Sunshine Station has been rebuilt as a transport interchange, and the long-awaited airport rail project will land in this corridor when it opens. The supply data is what earns this suburb its spot. 22 building approvals across 7,000 dwellings, 11.4-year hold period, vacancy steadily tight. The 9.5% 1-year growth is telling you the market has started to price in the corridor's demand setup. Strategic fit, solid Western Corridor exposure with an infrastructure tailwind. Property manager quality matters. Brimbank has a broader tenant demographic distribution than some inner East Melbourne LGAs, so select experienced postcode specialists. Braybrook, postcode 3019, the rent to price catch-up play. Typical price $812,000, yield 3.6%. The 6-month average vacancy rate is 1.05%. That's effectively the tightest residential rental market in any suburb of meaningful size across middle ring Melbourne. Functionally full occupancy. The second defining metric, 10-year rent growth of 5.5% per annum versus 10-year price growth of only 3.2%. Rent has compounded 2.3% more than price for an entire decade. That's an unusual pattern, and historically, it's one that resolves through a delayed capital value catch-up. Supply pipeline supports the setup. 36 building approvals in a suburb of 5,300 dwellings. Building approval ratio 1.67%. It's well within the supply-constrained band with a whole period of 10 years. Braybrook sits immediately north and west of Footscray and Seaton, both of which have structurally moved over the last decade. The gentrification diffusion pattern in Australian property has been consistent for a century. When one suburb moves, the adjacent lower price suburb moves next. Braybrook is positioned as the next obvious diffusion beneficiary in Melbourne's inner west corridor. It's got a slow burn, rent-led thesis. The 1-year growth of 4% is quieter than Sunshine North, but the underlying rent price setup is mathematically compelling over 5 to 10-year horizons. Highest yield on the list gives it the cleanest cash flow profile. Number 1, Noble Park North, postcode 3174, Greater Dandenong LGA. Cleanest supply-demand setup on this list. Every metric on the filter is at or near the best in list level. Vacancy 1.15%, trending down over the last 6 months. Building approval ratio 0.34%. 9 approvals in a suburb of 3,000 dwellings. Hold period 14 years, the longest on the list. 1-year price growth 11.37%. This is a textbook demand setup. Demand accelerating against a frozen supply base. Strategically, Noble Park North sits 5 minutes drive from the Clayton SRL East interchange. When Suburban Rail Loop East opens in 2035, Clayton becomes the southern hub of the Melbourne orbital rail network. Any middle ring suburb with direct access to Clayton and a genuine supply constraint is positioned to absorb spillover demand through the full 10-year lead up to SRL opening. Noble Park North hits both criteria. Combine that infrastructure tailwind with one of the tightest vacancies in middle ring Melbourne and a 14-year average owner tenure, and the setup is as clean as the data surfaces anywhere in the sub $900,000 Melbourne market. Strategic fit, 84 annual sales makes it feel smaller, less liquid. Exit flexibility is lower than West Footscray or Sunshine North, but for buy and hold investors with a 7 to 10-year horizon, the supply-demand algebra is the strongest on this shortlist. 3 risks that apply across the list because rigor matters. Cycle risk. Noble Park North, Sunshine North, and Thomastown are showing 9 to 12% 1-year growth. Mean reversion is real. Baseline expectation for years 2 to 5 is 5 to 7% annualized rather than the 1-year spike. Property management quality. Braybrook, Sunshine North, Thomastown, and Noble Park North sit in a broader socioeconomic distribution than your usual inner East Melbourne. Tenant screening and your property manager quality matters more. Factor an additional 1% of rent for premium property management over cheapest available options. Liquidity. Noble Park North does 84 sales annually, West Footscray 124. These aren't instant sale markets. If your thesis requires exit within 24 months, sizing and suburb selection matter differently than a 7 to 10 year hold. 5 suburbs, all middle ring, 10 to 20 kilometers from Melbourne CBD, all with vacancy rates at or less than 1.5%, all with building approvals at or less than 1%, and all with hold periods over 10 years. That is demand structurally meeting constrained supply. This is where middle ring Melbourne is compounding to set up over the next cycle, not from recent price spikes, which are trailing indicators. From the leading indicators, fundamentals, vacancy, supply pipeline, owner tenure, they tell you what's likely to happen over the next 5 to 10 years, not who already has. If this was useful, subscribe and drop a comment with which of the 5 you'd deploy your money into first. I'm interested and curious into which corridor this audience favors. If you want the same filter applied to your specific budget, serviceability position, that's exactly what the PropSpotter team do. We research, source, and coach. There's a free 20-minute strategy call with a link in the description.